Londra'dan herkese merhaba. Bu bölümde piyasalara özel bir parantez açıyoruz. Değerli bir yayın konuğumuz var. Citi'nin Gelişmekte olan Ülkeler Stratejisi Küresel Başkanı Costa ile buluşuyoruz. Hi Louis, thanks for joining our program.
Thanks for having me.
Let me start with the big picture. How has this war, Iran war, changed the market's baseline assumptions? There has been a lot of debate actually about the markets saying that they are looking surprisingly relaxed through much of the crisis. Do you think investors are underpricing the true risks right now?
That's right. I mean, I remember the last time we spoke, it was before the conflict. So, I mean, many assumptions have changed. And I do believe that this new environment, irrespective of the longevity of the conflict, right? I mean, we know that both parties are now kind of, flirting with a potential ceasefire. Let's see how it goes. And with the Strait of Hormuz pretty much being the center, the nervous center of the whole story here. But we are probably going to be in a slightly higher energy input environment in over the next months, right? Even with some degree of normalization, let's say there's a ceasefire, let's say there's a deal, we still believe that there can be a residual geopolitical risk in the barrel of oil and in natural gas in over the next months, which obviously calls for a revision of the CPI paths we had for many emerging market jurisdictions, and also calls for a revision of our expectations of central bank reaction function in this environment. So for DM and EM, right, it's not only an emerging markets issue, it's a especially for Europe, is an European issue as well, which has to be dealt with in the coming future.
Some say that the resilience of US earnings and the comeback in technology are masking geopolitical and macro risks elsewhere. Do you agree? And at some point, do you expect a huge, crash down in the markets or any risks accumulating in that side?
We're still relatively positive, and I like the way you put it, right? The momentum in the U.S. equity market, generally speaking, and let's be very clear here, when it comes to higher energy inputs, the U.S. economy is in a better position if compared to Europe, is in a much better position if compared to Japan. Right. So, and earnings expectations are still, especially in the tech sector, in some parts of the tech sector, they are still doing all right. I mean, in financials, we had, another round of reasonably positive earnings here. So that continues to hold the baseline, right, when it comes to U.S. equities, and which can be quite interesting in the future, right? I mean, if we are indeed expecting potential revisions down or growth in the developed world on the back of higher energy input prices.
Mhm. So your base case for oil now, what is that? I wonder because some say that again, economists and strategists are working with something closer to 70, $80, but it's now under $100. So
That's
what if
right.
Brent were to stay around $100 for a sustained period of time? What would it mean? Is it manageable or recessionary?
The baseline is something around for Brent around 80 $80, and which is, as you mentioned, is substantially lower compared to what we have now. I think that this is quite interesting. This is actually, I just came back from DC. This is actually more or less the IMF baseline, something around 82, 83 Brent average, right? Which probably tells you that if we remain at those high levels, I mean, something very close to 100 where we are now, if we remain at those levels, there can be adjustments in the markets and in general consensus out there, right? I mean, and it will probably, again, call for more cautious central bank action, where the central banks are not necessarily, they are obviously worried about the higher energy prices, but a consistent higher energy price baseline will probably call for secondary effects and inflation. And that's the biggest threat. If you start seeing contagion into food inflation, into other sectors, transportation, and how transportation impacts all the sectors of the CPI CPI baskets. That's the biggest threat now, especially for the emerging markets.
So, if I were to ask, what is the true cost of this war to world economy and markets? What would you say in a nutshell?
It is it's taking wealth off the system. I think it's very clear that it's not only a revision higher of inflation, but also a knock on the growth baseline, right? I mean, the question is how much in terms of growth are we going to subtract from the several jurisdictions out there? Obviously, some countries, some economies are a lot more sensitive to the growth shock, to the oil shock. Some other countries are now pretty much independent in terms of oil revenues, right? I mean, in terms of, oil or energy usage. I mean, these countries, they are in a much better segment of the market now. But generally speaking, when it comes to global EM and global DM, there's a subtraction to growth, in which we will probably go into a more serious territory if we are indeed talking about a long longevity conflict here, right? I mean, that's the question mark. How long it will take for us to try to normalize a little bit lower.
Who do you see as the real winners and losers of this war in terms of country, region, and central banks? Because they say that now the central banks are operating inside a fog of war, actually. So, how much has this conflict complicated this reactions functions of Fed and ECB?
It is a tug of war, right? I mean, I do see, now after chatting with so many policymakers back in DC with the IMF meetings, and I kind of structured in my head, two groups. I mean, the more sensitive central banks in economies that are a little bit more hurt, right, by the energy shock, and other central banks that are now in watch mode, right? I mean, and I do think that, for example, Egypt in North Africa, this is an important credit especially for the local frontier space, which is an economy that is now suffering, some degree of pressure. Is a sensitive economy when it comes to energy inputs, right? Turkey is also reasonably sensitive when it comes to energy inputs. So I mean, we've got in South in Asia. We've got obviously Japan in DM. I mean, Korea also an important sensitive jurisdiction here when it comes to energy imports and energy inputs. So yeah, you've got this, some central banks, some jurisdictions that they tend to be a little bit more sensitive, which will probably call for let's say an accelerated reaction function by central banks. But on the other side, we've got central banks, they are now on watch mode, right? And they're obviously uncomfortable because there was a global P&L shock, but these jurisdictions, they are not necessarily in the forefront when it comes to energy sensitivity. It's probably the case of Mexico, which is an oil exporter. It's probably the case of Brazil. I mean, many of these economies in Latam, actually, which probably calls for, it in a way kind of underlies one move that we are seeing now in terms of global investment flows in EM. I mean, investors are trying basically to hide, more in Latam if compared to emerging Europe, just because of this difference in terms of energy sensitivity.
What about Turkey specifically? Did you have any talks or did you hear any talks about Turkey in Washington, D.C. in the IMF World Bank meetings? And how do you see Turkey's positioning itself in this war?
It's obviously in this segment that tends to be as an energy importer, it tends to be more sensitive, right? I mean, but it's definitely, as I said before, it calls for an accelerated reaction function by the central bank, which is exactly what we had out of the Turkish central bank over the past weeks. And we do believe that we are not done yet, right? In terms of the repercussion of higher energy prices in the currency markets and on the inflation side, but we are seeing, a steady reaction by the Turkish central bank, which is good, It's good for the currency. We continue to believe that Turkish lira value and the path of Turkish lira depreciation is going to be super important to monitor and watch, right? If that continues to evolve on a gradual manner, is good for the economy. But obviously, right? I mean, as we saw, as we heard from the central bank in previous stances, I mean, they continue to highlight the fact that the inflation scenario is changing. Unfortunately, there's a much narrower window here of opportunity, at least in the short term, to cut rates. I mean, we actually saw the inverse, right? They, on an implied basis, they've been tightening conditions here in order basically to normalize and stabilize the Turkish lira, which we believe it's the right way, which we definitely believe is the right way to react.
6 months from now, what will matter more for markets? What do you say?
What will matter more for markets? Well, I think it's, I mean, we are, as you can hear from me, I mean, we are cognizant of the changes of underlying conditions or where EM is operated, but we are positive. We do think that the fluctuations over the past month or so. We are heading to pretty much week 7 or week 8, right, already of the conflict. So it's these fluctuations that they are opening some opportunities for investors. They are creating some value, especially on the local side. And it's quite interesting that in our conversations in DC, investors are they share the sympathy for the asset class. They understand that it's a tough moment. They understand that we all revise in inflation, our inflation assumptions and central bank policy rate assumptions, but by the same token, they also see value, down the road once the dust settles, and we do believe that the dust will be settling very soon. We don't think that this is going into a long-term squeeze in terms of energy prices.
Louis Costa, thanks for joining our program.
Thank you.
Citi'nin gelişmekte olan ülkeler stratejisi Küresel Başkanı Louis Costa ile buluştuk. Sözü İstanbul'a bırakalım.